What is the return of the S&P 500 gonna be in the future? This is a very nice question, and in this video I want to walk you through a little bit of a research that I did a couple of weeks ago actually. Well, this is the research. You can find it in the description if you want the complete research. It's not a true research. I'm not an economist, I don't study economics in university, and this is not an academic research. Nonetheless, it's a small research that I enjoyed doing, and in today's video, I'm gonna talk to you about it. Hey, it's Dario and this is Divity Finance, a platform where we can share our best tips and tools when it comes to trading, investing, or finance in general. And if you love the subject, please consider subscribing. So when we talk about the future returns of the S&P 500, of course we're talking about the future, but it's not like we can predict the future. We can only understand what is a possible future, a very likely future, and to do that we need to use the past, because the past is the only thing that we have. The present is actually already past, so the future, it's not possible to be used because it doesn't exist, so we need to use the past. So let us use a little bit of the past and let us take the returns of the S&P 500, so the prices of the S&P 500, the change in price of the S&P 500, and we get this nice graph. As you can see, this graph goes from 1927 till 2020, so till today basically, and you can see a very nice bull run. Of course, this bull run had very different scenarios, very different markets throughout. We had bearish periods, we had bullish periods, we had stagnations, so horizontal periods, but nonetheless the markets went up. But if we were an investor in the past, how much return would have we got investing in a certain period rather than another? This is the first question that we need to answer. This question answers a very fundamental question when we analyze the past returns to understand the possible future returns. So two are the questions. The first question, as we said, is gonna be answered something similar to the process that I just did with you. So the first question is, are the returns stable? So do the returns increase or decrease throughout time? Or do they stay stable? And the second question is, how much are these returns? So based on how we answer the first question, we will be able to answer the second question. So let us understand what were the past returns of the S&P 500 to understand if they were stable or not. So what we do is doing a so-called rolling investment. That means that we invest one time at a certain date, and then we invest again at a later date, again one time, and then we do this for 10 years. We keep the investment for 10 years, for example, or 20 years, 30 years, or 40 years. That's what I did. I did investments of 10, 20, 30, and 40 years, starting in November 1927, if I'm not mistaken. No, actually starting in December 1927, I'm sorry, and then keeping the investment until the end of November 1937. And then I did another investment 1 month later, so that's January 1928, the start of the investment, and kept that investment until the end of December 1937. That's another 10 years. So we have the first 10-year investment, then we have another 10-year investment, then we will have a third, a fourth, and we have 996 10-year investments. And then from there, we understand what was the annual return of each of these investment periods. And then what we do is plotting these returns on a chart. And then we get this nice chart that you see here. This awful actually chart is very easy to understand actually, and it's very easy to read. So every circle is the annual return of a certain 10-year investment. We see that if we started the investment around 1927, we have investments that have an annual return of around minus 10%. Then if we started the investment around 1949, we have that the annual return of an investment was gonna be around 15% of a 10-year investment. per year, so 15% per year for a 10-year in long investment. And then we again go down until 1965 more or less to reach a 0% of return, and then we go up again, and then we go down again, and then we go up again. As we can see, the returns, let's not look at the return as a numerical value. Let's just understand the movement of the chart. So we can see that the movement of the chart is very horizontal actually. If you think about it, the returns didn't go neither up or down. They almost stayed, the same. They fluctuated. Yes, of course they fluctuated. The price of the S&P 500 changes. So of course your investment, depending on when you start investment, is gonna have a different return. But at the end of the day, if we look at the big picture, we see that it's fluctuating horizontally. So there is no evident tendency of going up or down for the returns. But first of all, these returns are only for a 10-year investment. Second of all, these returns only take into consideration the price returns of the index. They do not take into consideration the dividends. Now, I couldn't find the total return S&P 500 with such data. So I have almost 100 years of data here for the price return index. I couldn't find the same for the total return. So what I did is using the price return index, and then what we're gonna do exactly now, adding the dividends, but without reinvesting them. Let us look at the other page. And first of all, I wanted to plot the dividends throughout the entire life of the S&P 500, so from 1927 till now. And we see that for 10-year investments, the dividend is actually going down. Now, I didn't study this tendency. I didn't want to go in deep with this tendency, because at the end of the day, when we combine the two, the same result as before comes out. So yeah, basically what I did is discarding this evidence, so the evidence that the dividends go down, and keeping just the end result, so the sum of the two. So what I did is, yes, summing the two. So taking the returns from the investment itself in the S&P 500 and the returns given by the dividend, and adding them together. Now, how did I add them together? It's written in the report. In the research. I will not tell you, simply because it's a little bit complicated. And so yeah, there is a little bit of math involved. So I don't want to bore you too much with math. So at the end of the day, what we come out with is these 4 charts. These 4 charts are for 10-year investments, 20-year investments, 30-year investment, and 40-year investments. And we have the returns of the index itself, so the price return of the index plus the returns given by the dividend. And we can see that the same chart, basically we have the same chart that we had before. So a horizontal chart that goes, yes, up and down, but it stays more or less there. So there is no tendency of going up and no tendency of going down, which means that we can answer the first question. So, do the returns increase, decrease, or stay stable throughout the years? Well, they stay stable. They stay pretty stable. So the returns of the S&P 500 will likely not decrease in the future. So the return that the S&P 500 can give us for a certain investment will probably not decrease or increase in the future. It will stay the same as it did for the past 100 years. So this is also another assumption that we make. If for the past 100 years the result has been this one, it's probably going to be this way for the future years as well. So let us now answer the second question. What is the return of the S&P 500? Now we could do an average, but is it actually okay to do an average? I don't think so. So now, instead of doing an average, let's first of all understand the distribution of returns, which means that I want to understand how many simulations did I make where the return was between, 2% and 3%. And then how many simulations did I did where the return was between 3% and 4%. And then I plot everything on a chart and I see these 4 charts. These charts tell me which returns have more simulations in them. So we can see that, for example, for 10-year investments, we have a nice range where we can state that the majority of simulations managed to fall in sense of the return. So the majority of returns probably fell between, 6% and 14%. something like that. Then if we look at the 20-year investments, we can see that this range goes from 5% and 11%. Then for 30-year investments, 7% and 10%, and then for 40-year investment, 6% and 9%, something like that, more or less, okay? It's just looking now. So now let's understand precisely, let's step up a little bit. What is the range of returns where 90 or more % of simulated investments managed to fall? And we come up with this table. This table tells us what is the range of returns where 90% or more of our simulated investments that we did in the past managed to have a return. So, for example, for 10-year investments, we have that 91% of simulations fell between 2% and 17%. 20-year investments, 91% of them fell between 5% and 14%. And then 30-year investments, we have 95% of them fell between 6% and 11%. And then we have 30-year investments, well, 97% of them fell between 5 and 10%. What do we understand from this table? We understand that the average return is basically the same. We can see that the average return goes from 9% for 10-year investments and 7.8% for 40-year investments, which means that the longer we keep the investment doesn't mean that the more annual return we get, but it means that more predictable the return is gonna be, because the range of return goes down, down, down. So the range of return becomes smaller and smaller. We can see that for 10-year investments, we have a range which is 2 and 70%. And then for 40-year investments, we have 5 and 10%. So much smaller. So the longer we keep the investment, the less risky the investment is gonna be. And the more predictable our returns are gonna be. So are these returns gonna be likely to be there for the next years? Absolutely yes. As we said before, if for the past 100 years it's been like this, why should it change now? We have gone through so many periods. We've gone through the Second World War, we have gone through pandemics, we've gone through many other things that happened in the world. I don't even want to mention all of them, otherwise YouTube is gonna say bye-bye to my video. But anyways, as you can understand, these returns also incorporate many things that can happen in the world, pandemics included. So at the end of the day, is these returns gonna be there in the future? Yes. What is gonna be the return? Well, for long-term investments, between 6 and 11%, I would say. Now, these investments, as I said before, do not include the reinvestment of the dividends, which will give you actually a very nice return, a very nice increase in returns. So be mindful of that. If you want to see the complete research with all the formulas and all the charts, I will give you the link in the description, so just check it out. I hope this video was helpful to understand a little bit more why we talk about the past to understand the future, and how we talk about the past to understand the future, so to understand the probable future. And I also hope that if you were scared about investing in the markets, this video will give you a very good grasp of why we invest long term and why we can be pretty much sure that our investments are gonna be worth more in the future. So this is all I had to say for the returns of the S&P 500. I hope you enjoyed the video. If this was the case, I really want to ask you to leave a like and let me know in the comments down below what you thought about this research. Did you like it? Do you think I should do something different? And yes, I will see you in the next video.